Hello everybody, and thank you for registering for our webinar on pensions and retirement planning. This webinar will last about 20 minutes. Thank you to all of you for taking the time to watch it. So we're first going to discuss the need for private pensions. Ultimately, people nowadays are living a lot longer than we did in previous generations. So what this means is that we have extra years to fund in retirement. So we're now looking at an average of potentially between 20 and 25 years in retirement with very little, if any, earned income or employment income, whereas in previous generations that was down to 5 or 10 years. Also, the cost of living in retirement, there's additional healthcare costs, the obvious one being potential nursing home. Some people decide to help the children out financially or even grandchildren. And there's the obvious risk of inflation where on an annual basis, everything gets more and more expensive in retirement. We're also looking at a lack of state support. So the state pension is currently about 13,000 per annum. There's a recent Mercer report done up to say that at the moment, for every 5 people working, there's only 1 person retired. By 2050, that's going to change to 2 people working for 1 person retired. So obviously there's going to be a bit of a gap there in terms of state funding. So it puts more of an onus on employees and the self-employed to fund their own retirement now while they can. Fund, enjoy and pass. So we need to fund our own retirement, pay for our living expenses, enjoy your retirement, which a lot of people forget to do, and also pass surplus assets on to the next generation. So the key to successful retirement planning is to replace your earned income, which is the income you get from working, with passive income. And if your passive income can be as much or at least close to what your earned income was in retirement, then you're doing well. So your earned income will reduce dramatically in retirement. Passive income needs to replace that. And simply speaking, a private pension is the most tax efficient way of building your own passive income in retirement. The Irish government incentivises workers through a 2 million standard fund threshold, tax relief on pension contributions, tax-free growth, and tax-efficient drawdown. And I'll touch on tax later in the presentation. Where does the max pension size come from? Well, if you consider a public servant, age 65 with 40 years service on a salary of 150,000 per annum, that person will receive 2/3 of his or her final salary for life as a guaranteed annuity on retirement. They also will be entitled to a lump sum of 1.5 times final salary. The calculation is simple. You apply a capitalization factor of 20. Now the exact capitalization factor does change from time to time, but let's just use 20 as a simple number. So multiply 100,000 by 20 and you get to your 2 million. So therefore, it's incumbent on those in this private sector to fund your own retirement. It's not built into your salary by default. So an example of where does a 1.6 million pension fund get me in retirement? Okay, so the first thing is you get 25% in a lump sum, the first 200 of which is tax-free, and 20% tax on the next 300,000. Of the remaining 1.2 million, you divide that amount by 20 to get a gross income of 60,000 per annum. The aim with the ARF is that while you're taking out the 5% per annum, ultimately you're looking to preserve that capital base as much as possible. So if a couple want to get to 120,000 per annum gross income in retirement, in simple terms, and there's a lot more to it, but just multiply that by a factor of 20 to look for a target combined pension pot of 2.4 million. So, okay, contributing to your pension, how do you get there? Firstly, contributions can only be made against earned income. So you can't make pension contributions against investment income. Employees and directors can accept both employer and employee contributions, whereas the unincorporated self-employed can only make employee contributions. This is a table outlining the age-based limits for the amount an individual can contribute personally to a pension. And bear in mind, there's an earnings ceiling of 115,000. This will be better illustrated on our example on the next page. And just the last bullet point there, company contributions do not count towards those limits. Proprietary directors, so those who are business owners, company owners, they have far more flexibility in alternating salary and pension contributions. It's not as simple and clear-cut as personal contributions in terms of the amount that can be contributed. So an actuarial calculation needs to be carried out to determine the max funding ability. This depends on a number of factors, including the age, your target retirement age, your existing pension fund value, your salary, and your years of service. So it's a complex calculation that's done by an actuary ultimately. This can result in very generous tax-efficient company contributions, essentially funding for back service. And that's the relevance of having, say, 10 years back service, because the revenue calculations will allow you to make a large employer contribution to cast back for the 10-year service that you hadn't been contributing to. Example, John is in his mid-40s. He earns a salary of 120,000 per annum. His company is putting in 6 grand as an employer contribution per annum into his pension. John, because he's in his 40s, can contribute 25% of either his salary or 115,000. In this case, 115 is lower, so it's 28,750. So therefore, John's net cost of the 28,750 is actually only 60% of that, because he gets 40% tax relief. So John's total pension contribution is 34,750. So for someone on a salary of 120,000, when nearly 35,000 can go in every year, that's a quite large amount. And obviously once John hits 50, more can go in again. The 25% goes to 30%. Elaine is a proprietary director of her own company. She's 10 years of a consistent salary. She has no pension at the moment, and she happens to have surplus cash on the balance sheet. So the solution for her is to carry out a max funding calculation, which we can carry out, and that may result in a very generous amount, such as 60,000 per annum as an employer contribution, ultimately for back service. From Elaine's personal point of view, there's no benefit in kind or tax implications, and there'll also be a full corporation tax deduction for her. Okay, so you want to get to 2 million or as close to it as possible. There's 5 factors. There's your current age, your target retirement age, the current value of your existing pensions, which is your base. There's also the assumed rate of return, which needless to say is a very, very important factor, and the future contributions that you're going to make. Once you have those 5 numbers, it's far easier to project your target retirement fund value. Here's just a couple of examples. 40-year-old with no current pension, by putting in 25,000 per annum with an assumed growth of 4% up to age 65, this pension fund gets to 1.04 million. Same person, by just contributing 10,000 more over 25 years, will see an increase of 420,000 in the value. So by contributing 250,000 more, which actually only costs the person 150,000 because of the tax relief, you're seeing a 420,000 difference. And that's the advantage of compound growth and tax relief. These are other numbers that you can study in your own time by just freezing the video. And just to give you a flavor of the different variables at play to getting to the max pension fund value. Okay, so now we're going to speak about the types of pensions. Slightly less exciting part of pensions, but nevertheless quite important. So a lot of us are familiar with group schemes, therefore generally large companies, the civil service, the public service, big companies with more than say 50 staff. They can either be defined contribution or defined benefit. Back in previous generations, these were predominantly defined benefit, but because people are living longer, that's a far greater liability for companies. So there's been a shift over the years to defined contribution, which ultimately puts the onus on the individual pension member to manage their own pension, as opposed to a defined benefit pension where it's managed for you. With group schemes, Investment options are limited and there's quite fixed rules and contributions. For individual schemes, for company directors or business owners, you're going to look at either an executive pension or a small self-administered scheme. PRSAs and personal pensions are great for the unincorporated taxpayers, so the self-employed or people who are working for a big company, but the big company don't have a sponsored employment scheme. Buyout bonds are great pensions. They're one-person schemes for housing ex-employment pension benefits. So if you've worked in a particular company and you've left, you can move your old pension to a buyout bond, personalized for you as part of your overall portfolio. Irish buyout bonds can accept transfers from UK pensions via QROPs. I won't go into detail of that here, but UK is the only country that allows benefits to be transferred into Ireland, but the Irish pension has to be set up as a QROPs approved buyout bond. Post-retirement, so once your pre-retirement pension is ultimately crystallized, an ARF can be set up between 50 and 75. It houses the 75% balance after the 25% lump sum is taken. You have to take a mandatory drawdown from the ARF. On your demise, the ARF is actually a capital asset that goes into probate or goes into your estate. An annuity is kind of the opposite to an ARF in that instead of you having a capital fund that's managed, you just sign up to a fixed income for life. That's predictable and secure. You get paid monthly, you get paid annually. But there's no legacy capital asset that passes on to the next generation. That's the big difference with an annuity versus an ARF. Just some miscellaneous points. 75 is the maximum age you can roll up a gross pre-retirement pension scheme via PRSA. A buyout bond can be retired from 50, as we've seen. 55 is the earliest a UK pension can be crystallised in Ireland when it comes from the UK into an Irish buyout bond. Very importantly, and this is often misunderstood, the employment retirement age that one has does not have to correlate with their pension's retirement age. They can be two completely different things. So if you've got 3 or 4 different pensions and they're all put in together, just be conscious that the retirement age of those pensions is completely different to the age that you want to continue working for. I know it's a bit misleading because we both use the word retirement age, but ultimately they are two different things. So you don't have to draw down your benefits at exactly the retirement age. It's a complex area. We're happy to talk to you offline on that. And counterintuitively, the more different pension accounts that you have, the more flexibility you'll have on drawdown. So it means that you can retire one pension at 55, another at 62, another at 64, and it just gives you that flexibility as opposed to having all the pensions in one big scheme. So you work for a big company and they have a group scheme, it's a bit of a no-brainer, just join that group scheme. If you've left a big company and want to manage your own pension, it's the buyout bond is definitely the way forward. If you run your own business, if you're incorporated, an executive scheme. If you're not incorporated, personal pension or a PRSA. And if you are about to retire, this is probably the most important time for pension planning. You need to look at all your options. You can take 25% out and move the balance to an ARF, or you can consider the annuity option. Tax advantages of pensions. So with a pension, you get tax relief going in. The company gets corporation tax deduction of 12.5%. The individual receives up to 40% on personal contributions and ABCs, which is a marginal rate of tax, but also on company contributions, there's a 52% tax relief because ultimately that's exempt also from marginal rate tax as well as PRSI and USC, which comes to 52% of the higher rate. And for the company doesn't have to pay employer PRSI on the contributions, which are up to 11.05% at the moment. Within the pension, the fund can grow to 2 million. There's no taxes to slow it down. There's no dirt, no income tax, no capital gains tax, nothing like that. And just as a technical point, the pensions threshold is actually 2.15 million because of a tax offset on the surplus chargeable excess and the tax in the lump sum. It's a technical point. If you do want more clarification, contact me directly and I'll explain it in more detail. Coming out of a pension, so you get 25% in a lump sum, the first 200 of which is tax-free. 75% goes into an ARF. Again, there's no growth taxes within the ARF. The first 63,500 of the ARF needs to go into an AMRF. It's just a technical point. Ultimately, it's pretty much the same as an ARF, except it's just a different account. On death, the ARF does go to your spouse tax-free. If there is no spouse, or on the death of a second spouse, it goes to the children or individuals over the age of 21 at a flat 30% tax rate. Now that's a flat income tax rate. It doesn't count towards the group thresholds for CAT purposes. That's a very important distinction and quite a technical point. So do get some tax advice on that or talk to us directly if you are looking for clarification on that. Also, the rate of income tax on pension income in retirement is a lot lower than one would expect, because people are used to paying 50% income tax at the higher rate in their working time. But actually when they retire, because of tax credits and the standard rate cutoff and married couples and joint assessment and all that, and no employee PRSI from when the state pension kicks in, actually the rate of income tax you pay is surprisingly low on your pension income in retirement. So let's compare pension investments and personal investments. So building up your own retirement fund is far more tax efficient by way of a pension. So, you know, a simple example would be if you contributed 1.5 million personally into investments over a 30-year period, that's really going to cost you about 90,000 because of the 40% tax relief. 900,000, should I say. And because of the growth taxes within a personal investment portfolio, a pension should grow about 30% faster on average than a personal investment fund, because there's no taxes to slow it down. So now hopefully you're convinced that a pension makes sense. So your question is, how do you invest it? The first thing you need to figure out is your level of risk. Generally, the younger someone is, or the further they are to crystallizing the pension, the more capacity for risk they have. So someone who's 45 years of age, all else being equal, should be able to take more risk than someone who's 65. But you could have someone who's 60 years of age and they've decided they're not going to draw their pension down until they're 75. So they might still have a long-term investment horizon. So that needs to be factored in. Different people vary in terms of their own risk profile. So you need to, complete a risk questionnaire, talk to an advisor and understand what your personal risk appetite is. This is very important. You need to look at all assets holistically. You should never ever look at just your pension in isolation. If you're deciding the risk in your pension, you need to look at that in the context of the wider investment or asset allocations that you have. I'd recommend personally to exclude your home from that calculation. So if someone has significant cash deposits personally, needless to say, they can take proportionately more risk within their pension. Equally, if someone has disproportionately high risk personally through property, leveraged property or a legacy investment portfolio that wouldn't make sense for them to crystallize for CGT purposes, then perhaps they should take on less risk with their pension. So this goes back to the importance of bespoke advice. And also, you need to obviously have a view on markets and asset classes and where are we currently positioned. And that's the input we would have, obviously, and having a view on where markets are priced at a point in time. Very simple. What does more risk mean? Well, it means more exposure to risk assets, and it means less exposure to low risk assets such as cash. Courtesy of JP Morgan Asset Management, this is a chart that was presented on a recent webinar that we hosted. Again, I'd suggest pausing the video here if you want to go through the detail of all the different squares here. But what this chart is hoping to portray accurately is that when one asset class is strong in 1 year, it's not necessarily going to continue every year. So you'll see that different asset classes underperform in certain years and outperform in other years. So it's a very simple graphic, I believe, for just illustrating the importance of diversification. So what can I invest in my pension? Well, invest in individual shares, bonds, passive exchange traded funds for low cost passive exposure. You can invest in active funds, investment trusts, real estate investment trusts, and you can actually invest in physical bricks and mortar property or direct investments like private equity, provided the trustees sign off on it. Restrictions are all investments must be at arm's length, so you can't buy a property personally and rent it out to a sibling, for example, and you can't invest in pride and possession investments such as jewellery and artwork and that type of thing. Structures, okay, so the main one is the big group schemes, and you probably don't have much choice. If you're a member of a group scheme, you have to just stay within that large structure. For individual schemes, we're lucky we've got 5 very strong insurance companies here in Ireland, with 6 apparently adding a pensions offering the next year or two. So insurance companies are very, very efficient, they're low cost, and they do offer a very wide range of investment choices. If you want something more bespoke, then a pensioner trustee company is perfect. I would always recommend a minimum of 500,000 for the pensioner trustees. And sometimes you can have a combination of insurance companies and pensioner trustees. Just to illustrate where markets are year to date, this chart shows 8 of the major global indices year to date. And you just see here from the back end of February, the extent of the fall that we experienced as a result of the COVID crisis. And also how from the back end of March, we've seen a nice recovery. Markets are still down significantly year to date, and are still significantly down from the highs, but at least a lot of the losses, or majority of the losses, have been won back as such. So this hopefully will just show you the extent of the severity of the volatility we've experienced year to date. If you were to look at this chart over a 20-year view, obviously the volatility wouldn't be as high, and that really does demonstrate the importance for a long-term investment view. This is the exact same 8 indices, but just on a 12-month basis. The reason why I'm showing this is because it demonstrates the strong market performance in 2019, and then the extent of the sell-off in February and March of this year, and again what the recovery has been since. I've only shown you 2 charts here, 6 months and 12 months. Really, for me, a 10-year chart paints the best picture. So just a couple of summary points. When should you not maximize pension contributions? Well, there's 3 instances. If you do not have a sufficient rainy day fund built up, you need to make sure you have your own quasi-personal insurance fund built up. That might be 30,000, might be 50,000, might be 80,000, whatever that number is for you, that takes priority here before pension contributions. You need to make sure you have personal regular cash flow to justify contributing. And you need to make sure you don't have any big upcoming capital outlay, such as buying a property or doing renovations to your home or whatever it is. Personally, my recommendation is to prioritize pension contributions over repaying the capital on your mortgage, purely because of the tax relief you get. If you don't have cash flow issues, please, please, please do maximize your pension contributions every year. And the closer to retirement age you get, the more you are allowed to contribute, and the shorter the commitment time period also. So as you get beyond 40, 45, the importance of pensions becomes more and more relevant. Again, don't ever look at your pension in isolation. You need to have a holistic financial plan, understand your existing financial position, so all of your assets, all of your liabilities. You need to also know what your cash flow position is every year. Are you running a surplus? Are you running a deficit? The cash flow calculation is a bit more cumbersome than the capital assets and liability calculation. It's something that we help people with. Once you have your existing financial position, you need to look at the softer details. When do you want to retire? What level of income do you want in retirement? Remember, that will give us the target pension fund value. You need to decide your asset allocation strategy, your investment strategy. And also, what are your risks? What are your concerns? Some people say, mainly in our advice, don't bother with individual shares in your pension. It's just an unnecessary risk. You're better going for more low-cost passive investments. Some people have a particular preference for physical property, others don't. So it's really important to, as part of your exercise, understand your existing financial position and also what your own goals, objectives, and preferences are. And once you have the first two steps, the third step is really about implementing the agreed financial planning actions. When we work with clients, we hold ourselves accountable to ensure that implementations are done. Summary points: take control of your pension, don't put the head in the sand, ensure you're actively managing it and you have good advice. Remember, it's time in the market, not timing the market. So don't worry too much about short-term volatility. If you have a pension fund with at least a 15, 20-year investment time horizon, then short-term volatility is largely irrelevant in the big picture. Always consider your retirement fund in the context of your overall wealth. Be tax efficient. So take our advice and contributions. Ensure your holistic investment strategy is tax efficient insofar as higher income investments are in your pension versus personally, all that type of thing. Avoid unnecessary risks. Avoid unregulated funds that have leverage, all that type of thing. You don't need to take on that level of risk in order to achieve your objectives. So just stay safe in terms of the choice of the investments that you use for your pension fund. And the last one is seek professional advice. Thank you very much. I hope you enjoy this, and we look forward to speaking to you soon.